Hi everyone, this is Matthew Stearns from Millennial Money Management here in Meadville, PA. Hope you're having a fantastic day today. I wanted to make this video to talk about the market downturn and the related behavioral psychology amongst investors and some of the things that I see that are are not helpful ways to think about the downturn and what is really the logical and I think proper way to think about this investment downturn that we're going through right now. So as it stands right now, in general terms, the average investor is down around 20%. More conservative people a little bit less, more aggressive people a little bit more. Okay, but I want to talk about really the inner workings. What does that mean? Because I get that question a lot. What does that mean? Like, where did that money go? And really help you understand what's going on. And I think it will help people draw more logical conclusions about this money that they've seen, as they've seen their account balances go down over time. So the first thing that I think is really key to look at is a home. Okay, so when people look at their home, they see an asset, right? It's a place for shelter, it's a place to eat and cook. But what they don't see is a dollar amount when they look at their home. It's just their home. Okay, it's a real thing. It has value, that is for certain, and it has some type of fair value that we have a general idea what it is. Okay. Well, over the last 2 or 3 years, we saw home prices, especially here in this area, which there's really no reason to have increasing home prices in this area because we don't have a large influx of people. Houses are getting older. There's really not a supply and demand issue. There was just, a rush for people to upgrade their homes and spend more money to get into a nicer home because of the effects of money printing and COVID and lockdowns and all of those things, okay? But did it really change the value of your home? Okay, and the answer is no. If you didn't update your home or do anything, the value of your home probably went down because guess what? It got older. Okay, so what we do when we look at our home is we don't see a dollar sign, right? We don't see, oh, there's $160,000 that I have. All right, and likewise, when the housing market goes up and the neighbor across the street sells their house for 30% more than it should have been sold for, you don't say, oh, I have 30% more wealth. I'm 30% more wealthy. Okay. And likewise, when the housing market goes down, you won't say, oh, I'm 30% less wealthy. Okay. You just see your home and you know what your home's worth on a good day. All right. And this is basically the same concept of owning investments in a retirement account and a 401k, but we don't think like that because whenever we log in, all we see is a dollar amount. And I think this is part of the problem that leads people to some irrational conclusions, which is things when I hear people say like, I had this much money or I've lost this much money. Okay. Because what we own in retirement accounts are shares of real things in the world. So when you have a fund, let's say you have a target retirement date fund, you own inside that fund owns shares of hundreds of different companies. Okay, and those companies' values are constantly being reappraised and readjusting depending on how much profits they're reporting, the market outlook, etc. And those shares will go up and down, and then all those shares are squeezed together and put in the one fund that you own as an investment. Okay, so those shares are constantly, every second of every minute, every day, being reappraised for what they are supposedly worth. All right, but in your 401k plan or your retirement plan, you at the beginning of this year, assuming you didn't make any contributions or withdrawals, you own the exact same amount of shares. You still own the exact same house, for example. And what happens is we go through times where those shares that we own, they get overvalued, right? The market tells us that, oh, these shares are really worth more than what they're worth. Okay, and sometimes they're fairly valued and sometimes they're undervalued. And what happened during COVID, because of a lot of free money, people coming out of lockdown with all this money, corporate profits went way up, market valuations went really high, and the valuations of all the shares that you own went up. They went up tremendously, probably. And what's happening now is we're trending back to what is a normal valuation. Now, hopefully, we don't go to an undervaluation, but even though your account balance is down 20%, you didn't lose 20% of what you owned, because what you owned weren't dollars. What you owned were shares. And you still own the same amount of shares. They're just appraised at a lower value. Okay, so I think that's really helpful to think about in terms of homes, because it's a real asset, just like a share of a company is a real thing. Your shares didn't change, just the value of the underlying shares have changed. So even the psychology of thinking when your account balance is up that it's your money is slightly incorrect. It's never your money until you sell it and you have the cash. Okay, and so it's also improper to say, you have this much money or you lost this much money. Okay, what you lost was actually the perceived value of the shares that you already owned and always have owned. Okay, you still own the exact same thing. We just go through these periods of things being overvalued and undervalued. And by really all accounts and all types of measurements, back in the beginning of the year before things started to go down, everything was overvalued. Okay, and I think a lot of people understand that. Homes were, stocks were, bonds were, the whole gambit. And that is all coming out. Okay, but it's not a loss of wealth. In fact, probably the reality was, you could have looked at it. Well, I shouldn't say you could have, but when you look at something like that, you say, all right, these are the shares I own. It seems like they're overvalued. My account's probably not really, all these shares probably aren't really worth $100,000. They're probably worth $80,000. So when it goes back from $100,000 to $80,000, you say, all right, that's what I thought they were worth. But that's not how people treat owning stocks. They just look at their dollar amount and it's just like a high watermark. They're like, this is what I have, this is what I have claim to, and when it goes down, it feels like you lost money. But that is not the correct interpretation of owning assets, right? They're constantly being valued, sometimes overvalued, sometimes undervalued, and right now we're just reevaluating what you own. And that also is a reason why you haven't lost any money until you actually sell your shares, okay? Because you still own what you owned at the very beginning of all of this, okay? So I know that doesn't make the story sound better when you're planning for retirement to use the money or things like that, but it is the logical and rational conclusion to why things are going down, and a way to reflect on, the account balance that you see now, even though it's 20% lower. Instead of thinking in terms of loss, thinking about it in terms of, these investments were overvalued before, they're fairly valued, and then we're all hoping that they don't become undervalued, because that's difficult. Okay, but that's where we stand now. I hope that was a little bit helpful, and I wish you guys all the very best out there. Thank you. Take care.